profits would be reduced. But in any case, they are enjoying a tax holiday. But again, they won't get a tax holiday on these transactions, I would believe, because it's not linked to your undertaking. There can be that argument also.
No, it would. And basically, look at I'm purchasing a product from a group entity.
Right.
Now, say in generality, the price of that product is 10,000 a kg.
Right.
By any chance, if I purchase it at 9,700, what really happens is 48 will be fine.
Right.
Because I am purchasing below a price. But the other part, it's like this, that means my ETI 10 profits have really, I am showing profits more than normal, so I get
So this is not about, I thought you're talking about actual sale of the brand or the product from one entity to the other. What you're talking about is normal business sale of your normal formulation or some products from one entity to the other. There you can justify, so you can still justify rather than justifying it by a price. A better approach would be to justify that the profits that come to that unit are not higher than the other companies, you know, in terms of the arm's length rate. Then you are satisfying both 40A2, because then you're saying that, you know, you're not excessively paying, also at the same time not overstating your profits. So that is still easier to manage. I was more on the issue of selling of certain branded brands from one company to the other, and that's where really IPR valuation comes into it. Any other question? Anybody else?
Yeah. How best will you test the management or business support?
The payout?
Payouts. Because right now we did speak about in the earlier slide,
Correct.
but that was on cross charge. And on cross charge, the auditor has to justify to say that the cost is justified from the perspective of Indian business.
Right.
But apart from the cost cross charge, if management fee is charged as such, along with markup, so how do you test the markup?
So management fee is like, what you're saying is that it's not cost plus, but if you say 3% management fee is paid, charged to India for rendering some XYZ services, right? So again, then you will have to go into that for the purposes also, if the management fee agreement says that my Singapore group entity will charge a management fee of 3% to the Indian entity for A, B, C, D services, then you need to understand that first whether those ABCD services have been received by the Indian entity. Second, whether the Indian entity has benefited from the services. If both the answers to this question is yes, then you need to get into that, okay, then what should be the payout? In that case, then you need to see what is the cost incurred by the Singapore entity to incur these services. And see that at the end of the day, so there will be a cost and there will be a management fee that will come from this 3% charge out. So the balance will be the profit. That profit on cost is what you will benchmark with other companies in Singapore rendering similar services.
So it's usually cost plus?
You will have to, the charging mechanism is not usually cost plus. It could be a link to sales or it could be cost plus. But the testing mechanism will have to be cost plus. Unless and until you come across an uncontrolled agreement which also charges, which is very unlikely that you will find one.
Okay.
So you will have to derive the cost. The cost will be the cost of rendering the services, management fee will be your income, the balance will be your profit, so you will have to compute that profit. That profit on the cost is what your cost plus will be, which you will benchmark with your comparator.
And what if the management fee is already mentioned in the agreement, negotiated agreement,
Right.
because of which the other party became A by itself? Would that take me out of, or would that by itself lead to the conclusion that the negotiated management fee is at arm's length?
That can be an additional argument to support, but I don't know if really on the basis of only standalone that argument you will say through. But that can add value for the evidence to the fact that you anyway, before becoming an AE, at the time of becoming an AE, only as a part of the shareholder agreement or JV agreement or whatever, this was negotiated. So it's not a transaction which is really after becoming an AE. It's during the process. But one can go and, the TPO, if they want to take an argument, they can say that because the wordings of the law are that
Anytime.
at any time during the previous year. So they can still say that it's a controlled transaction, and therefore that can have no bearing. But I think the higher courts will look at it more commercially.
So if the management fee
Yeah.
is net of tax, so you have to then justify the grossing up or the actual amount of pay.
No, the tax is not that you need to justify. You need to justify the actual amount.
So grossing up or non-grossing up, that can be a difference of.
Yeah, but then you have to see what is the actual transaction and justify that. You will not just take the net of tax and justify that and say that that is the amount that the Indian company is paying, because that is net of tax. What you need to say is that first, what is the management fee gross amount?
No, but there is no, the agreement is of net of tax. So grossing up, you have to
You have
pay
to
the
do.
tax. Yeah.
Yeah, so that is that's an outflow to the government. So that,
You don't-
no.
Madam, in the pharma industry, you really have a problem of getting comparables across the board because no segment results in terms of bulk formulation. Major of the companies really are trying to say pharmacy as one of these segments. So when we're talking of basic bulk and formulation differentiation or clinical trials or contract manufacturing, all this paid, and you're not really getting proper comparables. How do you really look at this?
My experience will be different, honestly, in pharma. Contract manufacturing, I have found it difficult to get comparables. But bulk drug and formulation, we have ample of comparables. I mean, at least more than 10, I can say.
A single company having both?
Single company having primarily one. See, you can make out from the product sales trend as to whether that company is primarily a bulk drug guy or a formulation guy. So if, say, your company is a bulk drug manufacturer, you want to compare with bulk drug, you may not get 100% bulk drug manufacturers, but you may get a company which is 75% bulk drug manufacturer. And you can do that computation by seeing the product sales. Because from the product sales, you can easily make out what is bulk drug and what is finished formulation.
Because what happens is when you are doing captive, bulk is also captively consumed. Now this is what will really come in the domestic transfer pricing in a big way.
Right.
And if you really look at the profitability at the bulk or the API levels are pretty low. And that's where the challenges would really come, where somebody is going to say that you have to look at the whole transaction and not just bulk as a separate, because on the overall, if you are making good profitability and it's all captive consumption, this could you need to look at the full basket in terms of the company and then do a bifurcation of profitability for the formulation and bulk. Or you really look at a bulk player independently and try to.
I think that is a better approach because you have comparables in pharma at least, where you can get bulk and formulation manufacturers. Clinical trials also you have number of companies. R&D also you have number of companies. The basic challenge that you get is in contract manufacturing. I guess just so to sum up, one of the most important things that I feel is your documentation needs to have a very holistic approach, and you should be aware, in order to be able to track, because see, most of the issues that are coming up in India are coming up from various global decisions. Whether you take marketing intangible, whether you take corporate guarantees, all these tricky questions and issues are coming from your global. So it becomes important to be aware of the global transfer pricing scenario if you really want to be ahead of the TPO to keep your documentation up to speed. And you need to harmonize your documentation, as I said, with other regulatory requirements, whether it is RBI, FEMA, customs, and not just have a myopic view in terms of looking at what is really required in the section 92. So that will help you sail, and I think now you have this window of APAs available. So at least that's a good thing. From an update status perspective, I think last year there were 140 applicants who went into AP, 146 to be precise. This year I think about 250, 260 people have gone in for pre-filing. Maybe not all applicants will go in for final, but at least 200 should go in. So that is showing that the APA mindset is a good, the authorities are coming out with good positive kind of mindset. So you know, for some of these complex issues, comparables not available, etc., you can go to an APA. So that's a good option available today. I guess I'll end my session with that and have a nice Sunday.
Thank you.
Request Dipender if he can give a vote of thanks and announcements.